Welcome to Legally Agile with Chris Werner.
Welcome back to Legally Agile, the podcast for founders and executives of high-growth companies who want legal strategy that keeps up with the business. I'm your host, Evan Mack, and I'm here with attorney Chris Werner, founder of Vidar Law. Chris helps high-growth businesses navigate risk, seize opportunity, and stay legally agile without slowing momentum. Today, we're looking ahead to big moments. Fundraising rounds and exits. We'll talk about what it means to be deal ready, how early decisions show up in due diligence, and the legal building blocks that make your company easier to fund and easier to sell. Chris, sir, welcome back.
Thank you. Good to be back.
Also, Chris, many founders only start thinking seriously about legal structure when a major round or exit is coming together. In simple terms, how do you define a company that's genuinely deal ready?
Yeah. So interestingly enough, most people think they are deal ready and they're not. If you're deal ready, that means that you've got all of your documents together. You've got them well organized, indexed. You probably have a number of different types of documents from your corporate minute book to what I like to call a war room setup. But having these things well organized, documented, and knowing where everything is going to make you truly deal ready. If you don't have that, you are not ready.
When investors or buyers begin diligence, what are the main legal areas they focus on across contracts, equity, IP, and compliance?
Yeah, so I think you ticked off a number of the things that they're going to be looking for. So they're going to be looking for, if you're a corporation, obviously your corporate minute book or the equivalent if you're an LLC. They're going to want to know what your company's rules are, your basic rules. They're going to want to know who owns the company and how much each of those people own. They're going to want to know what the relationship is between the owners or the stockholders and investors. They're going to want to make sure that you have done all of your compliance and kept up. So that's everything from annual reports for your company, your business licenses, to compliance if you are in, depending on what area you're in, you're going to have compliance reports that you need to keep on file and have ready to go. They're also going to be looking at your contract hygiene. So contract hygiene means that you know where your contracts are, you know what the major terms of those contracts. And you know how various contracts play with other contracts that you might have. And finally, for a lot of the companies I deal with, intellectual property is a big deal. They're going to want to make sure that you've taken care of that appropriately. And that means even internally, you want to make sure that your intellectual property that is created, even by your founders, is being assigned to the company and isn't held by an individual. And if you're not taking care of that, the default may be that the individual employee or founder does own some of that intellectual property, and that's going to really tank your valuation to an investor.
How do issues in those areas typically show up during the diligence, in a way that slows down a deal, changes the purchase terms, or, complicates negotiations, Chris?
Yeah, so I mean, I've seen this a lot. I've had in the last few years, I've had a smaller client who came to me and they were getting ready for a sale to a private equity group, and this company dealt with a lot of. They had a lot of contracts with their clients, and their war room was not ready for a deal. I got in with my team, and we spent probably about 4 or 5 months rebuilding their structure and their document room and getting things truly ready for the deal. One of the reasons we spent so much time is because the initial offers they were getting based on where they were on their contract hygiene, document maintenance, it was giving them lowball offers from potential buyers. So much so that it didn't even make sense to do a deal. Myself and my team had to get in there, really just completely rebuild everything. And then we were able to get them an offer that made sense for the company. But it took a lot of work, and so if you're not doing that ahead of time, you're gonna wind up having to do that later, and usually at a much more significant cost. And I can't tell you for sure that they wouldn't have had a much better deal had they had this prepared when they first started. But they definitely wasted time. They definitely wasted money. And the delay opens you up to risk, changing market conditions. Like, let's say you had a deal ready to go at the end of 2019, right? But your documents weren't ready and weren't organized. And so your potential buyer put the brakes on it, or investor put the brakes on it and said, hey, you know what, we need to spend some time cleaning this up. And then 2020 COVID hits, right? And everything changes. You couldn't have predicted it, you couldn't have seen it, but now the deal is put on hold indefinitely because no one knows what's going to happen with your business, no one knows what's going to happen with your clients. So you have now missed the opportunity to exit, and it may take months or years to get back to where you were. And so not being ready, not having a plan in place can really, in those unexpected situations, can really, really hurt.
In previous episodes, we touched on, contract disputes and foundational decisions. How do those early good enough for now choices tend to resurface when a company is preparing for a significant deal, Chris?
Yeah. So those early decisions can have a big impact. I've seen clients where they have a real mess of documents. Their equity grants to their founders are all over the map. None of them are consistent. I've even seen a client that one of the founders, their only documented equity grant was for a previous iteration of the company that didn't exist anymore. So they changed corporate forms, they didn't update all the documents. And now they had to go back and try to figure that out. And it led to some real tension among the founders then, because um, the whole structure, the whole environment of the company had changed in that time. And since they hadn't addressed it, one person has one idea of what it should be, and another person has a different idea of what it should be. So that can be a huge problem. Now, that doesn't mean that you need to, overspend on those initial stages, but you do need to make sure, or have somebody looking at it and saying, okay, these are red flags in 2 or 3 years when you're going to sell, or when you're going to do a big fundraising round. And if you don't have that, you're going to miss it. I wouldn't expect a founder to be able to track all of that. That's my job, right? That's why you bring me in. And I don't need to spend a ton of time, but I can spot those issues for you and prevent real problems down the line.
Is there a situation you've seen where a deal was slowed or discounted because the company's legal groundwork wasn't clean?
Yeah. So I can tell you about a deal that never happened because of that. So there was a company, great company, great product, invented something unique to the market. They had an opportunity to really consolidate with some competitors, turn a dispute into an advantage. But the company was not, their paperwork was a disaster. They didn't have their documents in place. They didn't even have their financials well organized. Not only did the deal fall apart, but there was a loss of intellectual property. The competitor was able to enter the market separately. And there was litigation that came out of it that lasted for almost a decade. And they never got back to where they were. So these things can have a serious impact. And this wasn't a bad company. This was a great company with a great product. But because they hadn't handled those things correctly, they missed out on a huge opportunity where they could have been 10, 20, 30 times the size that they are, had they been able to do this deal at that stage. And then once they missed that, the opportunity was gone. So it's not always possible even to clean things up and then go back to the deal. Sometimes, though that timing, once you miss the window, the timing's gone.
And on the other side of that, have you seen an example where, disciplined legal habits help the company move through diligence quickly and preserve that momentum?
Yeah, absolutely. So I can think of another company, not very big, small. It was two founders, and they had built the company, sort of bootstrapped the company for about 5 or 6 years, and they wanted to take an exit. They fortunately had all of their paperwork in order. I had worked with them almost the entire time that they were in existence, and for a lot of the early years, I did very little. It was very light touch on the things that I did, but we kept things well organized. We kept things well in place. They got an opportunity. They weren't actually seeking the opportunity necessarily. They were open to it, but they weren't out looking for it. The opportunity came along. Someone wanted to buy the company and fold it into a bigger organization. We were able to, within a month, have an entire data room that laid out everything that was going on with the company. We had all of their intellectual property organized. We had all of their contracts organized. We were able to tell the story of how much these contracts made, what the profitability was, and what their new business lead time was. And with all of that, we were able to close the deal. I think it only took a little over 60 days from start to finish to get the deal closed. Now, that it wasn't a big deal. I don't want to mislead anybody, right? If you're doing $100 million deal or more, right, you're not going to get it closed that quickly. This was a much smaller deal, but they were able to, with very little pain, get a deal closed and signed and done. And they were able to cash out with quite a bit of money in their pockets at the end of the day, because unlike what I talked about earlier, I wasn't putting a team on the ground spending 5 months redoing paperwork and files and trying to untangle a long mess of things that hadn't been well maintained for years. So so it absolutely can make it move fast. Doesn't guarantee it. There's always things that come up, but you're putting yourself in a much better position if you are well organized and ready to go at any time.
For companies thinking ahead, when should they realistically start preparing if a major round or exit might be 1 to 3 years out?
Yeah, so you should be thinking about it from the beginning. And so that story I just told, this company didn't start thinking that they were going to sell. They started thinking that, this is what we're going to do, right? But they had positioned themselves from the very beginning to take advantage of the opportunity should it come along. So I would always advise anybody who's starting a company to be thinking, okay, what do I want to do to prepare for that exit? Now, from the beginning. So if you are thinking about an exit, you absolutely should start, no matter how far your timeline is. So I have clients who tell me, hey, we're thinking about a big exit, but it's going to be 5 years plus. And I say, that's great. That gives us plenty of time to ease into getting everything done. But we are thinking about their files, their organization, their contract hygiene from day one, because it's going to make your life so much easier down the road if you can do that. And you should be thinking about it absolutely from day one. Now, the other advantage to that is it's going to make everything else easier for you, right? It's going to make your taxes easier if you keep your financial house in order. It's going to make your revenue projections easier, which makes it easier to know when to hire. It's going to, if you're dealing with purchasing inventory, it's going to make it easier for you to purchase. So it's not as if, you know, getting your house in order for a potential big investment round or a potential exit, it's not as if that only helps you on that. It helps your company all along the way. So whether or not you exit, it is still valuable to be thinking about your company this way and be disciplined in how you're thinking about it.
What ongoing habits in documentation, contracts, IP, dispute management, and basic compliance help a business stay aligned with the future investors or buyers will expect?
Yeah, so I think there's a number of things you can do, right? And again, each business is a little bit different. So there's not necessarily one playbook, but let's take this a little bit at a time, right? Contracts, right? So one of the things I do with companies is make sure that, okay, if you are doing the same kind of contracts over and over with your clients, let's put together a template contract for you to use, right? So that all of your terms are consistent across contracts. Um, for smaller companies, I will often give them templates and they will just use those templates and fill in. When they'll call me is, hey, this person on the other side wants a change of term. Can we change this? Um, when I know about that, we can document it and say, this is fine, or hey, we need to push back on this term. And then having your contracts organized. So I like to keep, obviously, like most people these days, everything is electronic. I really, I will print stuff on paper because I'm a little bit old and sometimes I will edit with a pen and paper, but I save everything electronically. And then I'll set up client war rooms for the clients to access. But keeping that stuff organized, in folders, it's basic, right? Well organized makes your life much easier. Um, in terms of, I think equity is a big thing to keep track of as you go, and it's very easy these days for founders to find um, YC agreements for safes or other type of early equity agreements. But what they're not necessarily good at is keeping track of who has what that means, and what their obligations might be. So not only do you have to know who the people are, how to contact them, but you also need to know, hey, do I owe an annual report to these people? Do I owe a quarterly report? And what is required to be in those reports? So keeping track of that, having a schedule and connecting that with your calendaring system or something else is extremely helpful. And then disputes, right? We've talked in previous episodes about how to handle disputes, but documenting those disputes is also very important. And if you've resolved those disputes, it's extremely important to document that as well. What you don't want to do is go into a big funding round or go into a sale and not be disclosing, previous disputes to your potential investor or buyer. Because if they find that and you haven't included that in your initial disclosures, they're going to put the brakes on. They're going to think, wait a minute, what else don't I know here? Do I need to dig in more? This is the other advantage to it, right? You want your investor or your buyer to think, hey, we asked for initial disclosures and look, we got all of this well organized. This all makes sense. It seems like everything's here. And when we look into things, when we look at court records or everything that we find is documented in this file. That means we don't need to dig any deeper with these guys, or we don't need to dig that much deeper. We can just focus on completing a deal. That makes your life easier, right? Like if you don't have all that well organized and documented, then if your potential investor or buyer doesn't just walk away, they're going to insist on really looking under the hood. They're going to really insist on going through everything. That's going to have a number of disadvantages, right? Number one, it's first and foremost, it's going to slow down your deal significantly. Second, it's very likely to reduce the price you're going to get out of this deal. And third, it may sour the relationship you have with the investor or the buyer, right? Like when they start asking these questions, it may come across as very personal, especially to a founder who has started a company from scratch and, built it over the course of years. When somebody comes in and asks questions in a way that makes it seem like, I'm not sure I believe you, that can feel very personal and can hurt that relationship.
Awesome. Chris, thank you so much for your time.
Hey, thank you.
All right. Thank you for listening to Legally Agile with Chris Werner. If today's conversation sparked questions about you or your company, whether it's legal foundations, disputes, or getting deal ready, you can find more resources at vidarlaw.com/podcast. There you'll also find a high-level deal ready checklist to start preparing for future fundraising or exits. If you found this episode helpful, please follow the show and share it with another founder or executive who'd benefit. We'll see you in the next episode.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.